Fed policies caused the markets to move up. What did the Fed did? Hey, it's Linus here. So yesterday, the Fed releases its statements, and in today's video, I'll be sharing with you the main points of the Fed's announcement. The Fed's announcement and statement center around these three main things. The first is tapering, the second is interest rates, and the third is inflation rates. So in today's video, we'll be taking a look at these three main things. So we begin with the Fed tapering. So right now, the current monthly bond purchases made by the Fed stands at 120 billion. And according to the Fed statement yesterday, we could see this amount being lowered in November. Because in November 2nd or the 3rd, there will be a meeting by the Fed again. And during that meeting, they might lower the monthly bond purchases, and this is dependent on the job growth throughout September. So the Fed mentioned that as long as job growth through September is reasonably strong, they could look to taper and lower their current monthly bond purchases. So what does this reasonably strong means? According to the Fed, he mentions that it wouldn't take a knockout or super strong employment report to start the tapering of the bond buying program. Right, so as long as job growth remains relatively strong in September, the Fed might start tapering their bond buying program in November. And this whole process is expected to wind down by the middle of next year. Which means that if everything goes according to plan and is smooth sailing from here, the Fed is expected to start its tapering in November, and then it will continue to taper more and more until it stops the bond buying program by the middle of next year. But again, this is dependent on everything going according to the Fed's plan. And an important point to take note about the Fed tapering is that the Fed wants to end their monthly purchases before they start raising interest rates. So as long as the monthly purchases continue, the Fed doesn't want to raise interest rate just yet. So by this, we can assume that if everything goes according to plan, the Fed plans to stop their tapering by middle of next year, which is 2022, and then only after the middle of 2022 will the Fed consider to start raising interest rates. So that is the tapering by the Fed. Next, let's take a look at the interest rates. So far, the Fed is holding its interest rates target steady at 0 to 0.25%. And like we talked about it earlier on, the increase in interest rates is likely to be earliest in the later half of next year. Right, so the Fed wants to stop its tapering program first before it considers raising interest rates. Furthermore, right now, the Fed's stance is that they want to prioritize unemployment rate first. They want unemployment rate to be low. So what is low? So they want unemployment rate to be at least at the pre-pandemic level, which is at around 3.5%. So between the two, unemployment rate and inflation rate, so far the current stance of the Fed is to prioritize unemployment rate first. And that is why even though inflation rate right now is relatively high and above their target rate, the Fed is still holding interest rates down. So if the Fed prioritized inflation rate over unemployment rate, they would raise interest rates to combat the rising inflation rate. But right now, because they are prioritizing unemployment rate, they want to keep interest rates low in hopes of stimulating and boosting the economy and raising employment rate, thus bringing down unemployment rate. The next one that we'll be taking a look at is the inflation rate. So in their latest announcement, the Fed expects inflation rate to be 4.2% this year. And at 4.2%, this is more than 2x its 2% target. So the Fed's long-term inflation target is at 2%. But right now, the Fed projects inflation rate to be 4.2% in this year, which is 2021. The Fed also projects inflation will be above its target for 4 consecutive years. So for 2021, 2022, 2023, and 2024. Right, so for 4 consecutive years, the Fed projects that inflation will be above its target rate of 2%. So what are the expected inflation rate that the Fed projects in the coming years? Let's take a look. As mentioned just now, in 2021, the Fed expects inflation rate to be at 4.2%. That is 2.2% more than its target rate and 2 times the target rate. And in 2022, the projected inflation rate by the Fed is at 2.2%. So that's 0.2% more than its target rate for 2022. And for 2023, similarly, their target rate is also 2%, and the projected inflation rate for the year will be 2.2%. So same as 2022, the projected inflation rate will be 0.2% more than the target rate. And for 2024, the target rate is also 2% because the 2% is its long-term inflation target rate. For the projected inflation rate for 2024, it is 2.1%, so 0.1% more than the target rate. So even though the Fed has revised its projected inflation rate upwards for this year, 2021, to 4.2%, which is more than 2 times its target rate of 2%, the Fed still believes that inflation is transitory in nature. And inflation is likely to go down in the subsequent months and years once the supply factors issues are solved. So that's a summary of what the Fed announced yesterday. Hopefully you have enjoyed and learned something from this video. If you did, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And if you are new to this channel and haven't already subscribed, Make sure you subscribe to my channel because each week I release new videos about investing, trading, and the stock market. I'll see you in those other videos to your financial success.